Imagine this. You have a little extra cash after a tough month. It's not a lot, but enough to make you think about what to do with it. Should you invest it and start building wealth, or should you use it to pay down your debt and move closer to financial freedom? This isn't just a simple question. It's a critical decision that can shape your financial future. In this discussion, we will explore the complexities of the invest or pay off debt dilemma. By the end, you will have a comprehensive understanding of how to make the best choice for your circumstances. Understanding the financial context. The decision to invest or pay off debt depends on several important factors. These include the type of debt you hold, the investment opportunities available to you, and your emotional capacity to handle financial stress. Not all debt is the same, and neither are all investment opportunities. High-interest debt, such as credit card balances, is fundamentally different from low-interest obligations like a mortgage or student loans. Similarly, an investment that promises an 8% annual return differs significantly from riskier ventures with uncertain outcomes. Moreover, your emotional tolerance for carrying debt or delaying investment plays a vital role. Some individuals are deeply uncomfortable with debt, while others can manage it as a tool for wealth creation. These aspects must all be considered before taking action. The impact of high-interest debt. High-interest debt is often a significant impediment to financial stability. For example, credit card debt with a 20% annual interest rate is a substantial financial burden. If you are paying 20% interest on a $10,000 balance, you're incurring $2,000 in interest charges annually. Compare that to investing the same amount and earning a 10% return, which yields $1,000 per year. The gap is stark. You would lose $1,000 annually by carrying the debt while investing. In this case, paying off the debt is clearly the superior choice. Beyond the numbers, high-interest debt often carries a heavy psychological toll. It can create stress and anxiety, undermining your focus and financial confidence. For these reasons, eliminating high-interest debt should typically be a top priority before considering investments. Low-interest debt, a more complex decision. Low-interest debt, such as a mortgage at 3% or a student loan at 5%, presents a different scenario. The urgency to pay off this type of debt is much lower because the cost of borrowing is relatively cheap. If you can earn an 8% return on investments while paying only 3% on a mortgage, you achieve a 5% net gain. This dynamic creates a compelling case for investing instead of aggressively paying down low-interest debt. However, it is crucial to account for the inherent risks of investing. Market returns are not guaranteed, and investments can fluctuate in value. If your financial plan depends heavily on achieving specific returns, you need to be prepared for market volatility and potential setbacks. Diversification and a long-term outlook are essential when pursuing this strategy. The psychological aspect of debt. Financial decisions are not solely about numbers. They are deeply tied to emotions. Debt, even at a low interest rate, can feel burdensome to some people. The psychological relief of being debt-free is invaluable for those who experience significant stress from owing money. On the other hand, individuals who are comfortable managing debt may find it easier to focus on investment opportunities that align with their financial goals. Recognizing your personal relationship with debt and money is an important step in determining the best course of action. When to prioritize investing. There are specific situations where investing should take precedence. For instance, if your employer offers a 401k match, you should prioritize taking full advantage of it. A 100% employer match is essentially free money and represents an unparalleled return on your investment. Similarly, the earlier you start investing, the more you benefit from the power of compounding. Investing $10,000 at age 25 with an 8% annual return can grow to over $217,000 by age 65. Delaying by just 10 years reduces that amount to approximately $100,000. Time in the market is one of the most valuable assets an investor has. Additionally, Building an emergency fund should be a priority before aggressively paying off debt or investing. An emergency fund ensures that unexpected expenses do not force you to take on more high-interest debt. Having 3 to 6 months of living expenses saved provides a financial safety net and greater peace of mind. Striking a balance. For many, a balanced approach is the most practical solution. Dividing your extra funds between debt repayment and investing allows you to address both goals simultaneously. For instance, you might allocate 70% of your available cash to paying off high-interest debt and the remaining 30% to investments or retirement savings. This approach enables you to reduce your financial liabilities while still taking advantage of compounding growth over time. It may not be as aggressive as focusing solely on one goal, but it is often the most sustainable and rewarding strategy. Common mistakes to avoid. When deciding between investing and paying off debt, there are several pitfalls to avoid. First, avoid prioritizing the early payoff of low-interest debt at the expense of long-term investment opportunities. Paying off a 3% mortgage too quickly can result in missed opportunities to earn higher returns in the stock market or other assets. Second, do not invest while neglecting high-interest debt. Carrying a credit card balance while trying to grow an investment portfolio is counterproductive and financially harmful. Finally, avoid making decisions without a clear plan. Randomly allocating funds without considering your overall financial goals can lead to frustration and suboptimal results. Develop a comprehensive strategy tailored to your specific circumstances. Actionable steps. To make an informed decision, follow these actionable steps. Begin by assessing your financial situation. List all your debts, their interest rates, and your monthly obligations. Next, analyze potential investment opportunities and expected returns. Prioritize paying off any high-interest debt above 8% as quickly as possible. Take advantage of employer-sponsored retirement plans and matching contributions. Ensure you have an emergency fund in place before committing to aggressive debt repayment or investing. Finally, consider adopting a balanced approach that aligns with your financial goals and risk tolerance. Conclusion. The choice between investing and paying off debt is not a one-size-fits-all decision. It requires careful consideration of your financial landscape, emotional preferences, and long-term goals. High-interest debt is a significant obstacle to financial freedom and should be addressed promptly. Low-interest debt, however, can often coexist with investments if managed strategically. Remember, the ultimate objective is not just to eliminate debt or grow your portfolio, but to achieve lasting financial stability and peace of mind.